Well, we have a lot of stocks to talk about as well, along with that market action. So in just a bit, this is the list that we are covering on our top 10 segment. We'll be looking at Z Entertainment, Voltas, NTPC, Glenmark Pharma, Bharat Forge, Hindustan Aeronautics, RVNL and GMR Airports. These are stocks on the radar on the back of positive news flow. TCS and Samvardhana Motherson are stocks on the radar because of some negative news flow that surrounds them.
All right, let's get our first voice, and this is, of course, has to be a global one to begin the day. Danielle DiMartino Booth is CEO and Chief Strategist at Quill Intelligence LLC. She's joining us right now to take some questions. Thanks very much, Danielle. Great to have you with us here on the program. Appreciate your time. You know, as we get into the last session for the week, and what a week it has been, do you reckon things are looking a little better overall, both in US and in Europe, especially on the banking side, and implications henceforth for equities, etc.? Or is it still very uncertain?
So I think we're still very much in tenuous territory. You've got First Republic trading down it's going across the bottom of the screen right now, trading down about 17%. In the after hours, there was news that came out from the Federal Reserve after the U.S. stock market closed that the uptake at the discount window was the highest on records, including taking out the highest from 2008, from the great financial crisis. So it's clear that banks are feeling a lot of distress if they're pulling up for $150 billion in very expensive liquidity from the Fed. So I think what's at the front of a lot of investors' minds at this point is, yes, we had a consortium of 11 banks come in and inject $30 billion into one U.S. bank. Yes, the Swiss National Bank is injecting $50 billion into Credit Suisse. But the question that I'm being asked more and more is it going to be enough?
What do you think, Danielle? I think that is the $1 billion, or maybe $1 trillion question, right? The show of confidence from central banks and some of the big boys on Wall Street. Is it a sign of confidence, or is it a sign of perhaps further trouble beneath the surface?
So I think it's more a sign of stress and distress. You saw similar types of consortiums come together, whether you're talking about the 1907 financial crisis or whether you're talking about the 2007, 2008, 2009 financial crisis. When you have a bunch of banks come together and say, okay, we're going to join hands and make sure that we don't see systemic risk come unleashed, these aren't typically the things that instill confidence until you get a true stabilization in the market. And we're also looking forward to the unleashing of a global recession right now. Banks are going to be clamping down even more in terms of credit creation. And the U.S. economy, for one, is one that requires constant credit creation in order to function.
So in light of all of this, there is a Fed meet next week. What do you think they do?
So, I've been telling our clients that as long as there is nothing systemic that occurs over the next few days, that the body of evidence suggests that services inflation in the United States, at least, is running hot enough for Chair Powell and the rest of the officials on the Federal Open Market Committee to raise interest rates by another 1/4 percentage point. That's my base case. Again, assuming we don't have a crazy Friday or even a crazy Sunday like we had over the last weekend with a bank failure on a Sunday, to take but one example. If we don't, then I think the Fed presses forward.
You said that unless there is anything systemic, I mean, how long before it really gets systemic? Because these things usually start off as stray incidents and it only, is gradually stray until it suddenly becomes systemic.
That's exactly right. That's absolutely right. I mean, in 2007, we had Bear Stearns, and that was kind of the first shot across the bow. Do we know if Silver Lake, Silicon Valley Bank, and Signature, or is that a Bear Stearns moment? Or is this closer to what transpired a year later with Lehman Brothers? It's very hard to say, because what's happening right now compared to Bear Stearns all those years ago is the rapidity with which we're seeing things play out, and the fact that it's not just a United States isolated issue. We're also seeing, obviously, the unrest at Credit Suisse.
Okay, so Danielle, we've heard you carefully. Given all of this, What are you doing with stocks? Actually, what are you doing with money? Are you putting it in U.S. equities, elsewhere, emerging markets? Are you moving it to bonds? Where's the money going?
So I actually think long maturity U.S. bonds are a great place to be if we're going into the recession that most people now acknowledge is going to occur. And now that we've had multiple bank runs, most Americans are fairly in touch with the fact that they can get 5% on their cash. I don't think that that was as well recognized before we started seeing bank runs. And precious metals are also doing extraordinarily well under the current circumstances. And this is what we effectively say, making sure that your portfolio is defensively postured until this wide level of uncertainty passes.
Daniel, just one last point. Is anyone seriously doubting that any of the larger banks are in trouble? Or because, what I heard was there is outflow from regional banks into larger banks, if anything. So regional banks are...
Correct.
Yeah, go on. Sorry. Go on. Yes.
Small, especially small and regional banks, they have a much lower insured deposit coverage ratio, so they're much more vulnerable. And you are absolutely correct. The largest 4 banks in the country have been inundated, deluged with deposits since this happened. And that's why they're able, the largest 4, to give up $5 billion apiece in deposits and try and help prop up First Republic.
So the $160 billion, which has been borrowed from the Fed, from various Fed programs or windows, this is being borrowed by, I assume, smaller banks?
And potentially regionals. It's a very large number, actually. Again, it's the large, it took out the financial crisis 2008 high. And I think that that was what made markets nervous after the close. So it's clear, I mean, banks do not want it. They're penalized going to the discount window. It's the last thing that they want to do. And yet there they are in record numbers. So we won't know what the identities are, but it certainly has instilled a higher level of nervousness into the markets that there are that many banks willing to take the penalty in order to get access to that Fed lifeline.
All right. Daniel, thanks very much. Great conversation. Appreciate you joining in here this morning on CNBC-TV18. And let's just hope that we don't get another accident Sunday evening.
Fingers crossed.
Fingers crossed.
Yes, thank you for having me.
Thank you. Well, we'll take our first quick commercial break here. We'll come back. Our list of top stocks to watch. Our team will be with us to detail that out for you. TCS, of course, top of minds. Stay with us. We're back.